To Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have a weekly strategy roundtable where we talk about current market conditions and any questions you might have about your Tradespoon subscription and what to expect in the market next. For those of you who are new, if this is your first live event, do me a favor, type in first. Always want to welcome new subscriber. This is my brief bio. I started Tradespoon in 2012. Prior to that, I was executive vice president and head of technology at Options Express, which was online broker dealer acquired by Charles Schwab. A company went public in 2006. I left 2007, started Tradespoon 2012. I want to take this opportunity to say thank you to all the subscribers. Because of you, I'm able to do what I enjoy professionally, managing and trading my own money. I've been doing it for over 15 years, mentoring and teaching subscribers how to trade stock and options. And finally, I have a master's degree in computer science, specializing in statistics. Disclosures are very important. Trading stock and options involve risk, not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. All right, let's take a look at the market. So we basically retested 52-week low, right? The June-July lows. So whether you look at QQQ, you look at the semiconductors, VTV value stocks are actually trading below June lows, or spiders. We are, for all practical purposes, retesting the lows. So market is extremely oversold, right? It's probably trading on this final kind of wave down, especially heading into the weekend. Nobody wants to hold the long positions. So it's important, obviously, for the bulls to hold on to these levels. My personal opinion is that these lows will hold. We can overshoot. Maybe we can even drop to 350. But I don't think we're going to have imminent breakdown, right? We're not heading to 320 or 300 now, right? I think 360, 350 level will hold. But again, until you determine what the bottom is, right? Everybody wants to know where's the bottom, right? Are we close to the bottom? How far the bottom is? So if you look at the 6 months predictions, we predicted that 410 is the top, 369 is the bottom. We're already trading close to the bottom, right? And we still have a week left. We have seen that the market can trade below that level, maybe closer to 350. But I still think that we're gonna, going into the midterm elections, we will rebound back to at least 409 level. So can we reach 369? We already reached that level. Can we reach 350? Can the market overshoot? Yes. But will the market be at 315 in October or November? That's not the scenario that I think is likely. But again, in order to determine where is the bottom, you need to see signs of bottoming process, right? And right now, there hasn't been any, right? So we need to kind of wait and see. For the, usually 2 to 3 days. We need 2 to 3 days of higher highs and higher lows to basically say that we are probably close to the bottom, the way we had in June, May, June, July, right? Once you have 2 to 3 days of these violent moves to the upside, then you know that the bottoming process has started. Right now, market is in a free fall, so there is no really signs of bottoming process. I'm looking at the 10-year yield, right? We have flattening of the yield curve, but the 10-year yield did drop, right? We had a violent move again to the upside, almost close to 4%. I think 5-year yield was at 4%, right? 4.10, 10-year yield rally, and then it did drop. So the overhead resistance is around 360, right? This is where the breakout happened. So we do have to trade, market has to drop below 360, 350 range for the bottoming process to start. As long as we're trading above 3.6, as long as the dollar continues this vertical move to the upside after, intervention from Japan, monetary policy, intervention from Britain today, we do see these vertical moves to the upside in dollar and in 2-year yield. right? So that's still bearish. It's still bearish, so we just have to wait, right? I think we're getting close to this, at least some signs of stabilization. Maybe early next week, Monday or Tuesday, I think there will be a reversal. But again, 2 to 3 days is usually the rule. So again, $1 million question is where we're going to be at. Well, we're practically in October, right? We're retesting the lows. There are two scenarios, right? The one scenario right? One scenario is that we touch the bottom, right? And we rebound back into November, right? Maybe a double bottom, right? Maybe double bottom. And then after the midterm elections, we're trading higher. Right? We're not posting new highs, right? I don't think it's reasonable to expect new highs, but you know, lower high is reasonable to expect. Maybe 400, maybe 410. So that's scenario number one, right? Kind of this double bottom, triple bottom. Maybe you know, maybe slightly below, right? Maybe we overshoot or undershoot. That's hard to determine. But nonetheless, end of this, you know, December we do, end of the year we do have the Christmas rally, right? That's scenario number one. Scenario number two, you know, maybe we same kind of things, but you know, instead of going higher, we are, you know, heading lower, right? End of the year. Scenario number two. I mean, I don't see any other scenarios. Right? Market is not going to just sit on this line where everybody's nervous, right? It's either going to break down and continue to roll down, right? Maybe 10, you know, we are at 360, right? We are at 360, so that's 10% to the upside, right? We're either going to go 10% to the upside or 10% to the downside, right? So maybe 360, 40 points, 320, right? 320. 320. All right, so scenario one, we're up 10% from these levels till the end of the year, right? Or the other scenario, we're down 10% to the end of the year. All right. So how many of you say one and how many of you say two? And again, important exercise, right? If you say one, you probably want to start reducing your hedges, right? Reducing your hedges and either be market neutral, maybe slightly bullish, or at least market neutral. If you say two, you probably want to be either market neutral or bearish, right? So it's important in terms of your portfolio composition. How do you want to go into the end of the year? Right now that we are end of September, you know, everybody already started talking about the midterm elections, right? That will create volatility, and then, you know, going into the end of the year. So one or two, let's see. I'll give you some time to think about this. All right, Peter, one, Mark, one. Okay, Kevin, Kent, Vitus, Clayton, Chuck. What do you guys think? Abraham, Aladdin. Scenario one or scenario two? You know, there's still people that think we can get to all-time high by end of the year. You know, I don't think this is a likely scenario, you know, or even posting higher than August high, I don't think is a likely scenario, but, you know, let's talk about at least one or two. You know, if it's 430 or if it's 300, you know, it's still one or two. All right. All right, twos. Okay, so we have half of the people said say two, half of the people said one. So basically reflects, you know, and if I ask, you know, 10,000 traders or 1 million traders, it doesn't matter. The answer is, you know, at this junction is going to be the same. 50-50 split, right? I think that, I think this is actually pretty optimistic. I would say majority of people would say, in a different audience, majority of people would say 2, right? Because market is falling, kind of in free fall. So most people say 2. But it reflects the uncertainty. It reflects the uncertainty in the market, right? War in Russia, Ukraine, what the Fed will do, how long the inflation will last, what the earnings will look like, right? We're heading into the earnings season. So that's good. So, my personal opinion that, I favor 1, right? End of the year, we are somewhere in here. Right? So I favor, this is my preference. I mean, not preference, but this is what I think is going to happen in the market. I do think that these levels will not hold, right? The question is, okay, end of the year, 1 or 2, but then the second question, will the lows hold? My opinion that the lows will not hold. And we're probably not close to the bottom in the market. But then the question, is this going to happen, October, November, or is this going to happen, I don't know, January, February, March? My, opinion is that we will do this, we will break the market, we will have some kind of a capitulation, but in March, right? In March, that's what I think. Can it happen now? Not a preferred scenario, not highly probable, but it is possible, especially if this, it all depends again on what, world economies will do in terms of government. If the dollar has this parabolic move and it continues on into the next week because of the interventions from Japan or England or European Union, dollar, British pound approaching parity, euro is below parity, then and the 4-year and 2-year yield continues to go, to 5% or 4.5%, then we will, at some point, there will be dislocations. There will be dislocation in currency market and in treasury market, and when that happens, that's when the VIX is going to jump, not at 29 level, but it will jump above 40 level. When is this, it's kind of, when will this shift occur or this balance occur, right? It's hard to predict. I think most consensus is going to be next year, but we'll see. It could be this year. I just think I still think it's a relatively low probability event. All right, but meanwhile, again, my opinion, don't try to call the bottom, right? Don't try to call the bottom. Look for signs of bottoming process. As of right now, you look at the spider's charts, it's a fallen knife. There's no signs of bottoming process, so you either stay market neutral or slightly bearish. Some of the rules that also help me trade, portfolio allocation. We're definitely trading in the bear market. I think there's very few people you can find that still think we're in a bull market. You can just watch the CNBC and Bloomberg, which is a contrarian sign, right? When everybody was bullish, then that's a problem. But now that majority of people are bearish, that's actually good, right? Put and call ratio are actually very elevated, right? So I propose 50% of your portfolio to be in cash. 50% of your portfolio in cash. And portfolio drawdown, 4 positions, 2.5% of account value, right? So this way, you know that your maximum drawdown is 10%, right? You have 10% drawdown and 50% of your portfolio in cash. Immediate question, very often people ask me, well, okay, so if I have 4 calls positions, right? Let's say I have $10,000, right? Average account is $10,000. So you have 4 call position, right? Let's say I think market is overdone and it's going to rally. So I have 4 calls, right? And I put, let's say, $250 into each, right? 2.5% is $250 each, right? So $250 each. So then that's $1,000, right? So I have $1,000. That's in option, right? This is your option value, right? Option value. But then my cash is $90,000, right? My cash is, sorry, $9,000. So 90%. So 90% is in cash. So immediately, if you're a new trader, and this is the most common mistake everybody made. I did this, everybody, I think, will do this. Basically say, well, Vlad said 50% in cash. So I can have maybe, instead of 4 calls, right, of $1,000, you know, maybe I have 16 positions, right? 16 positions, right, where I manage $250. Right? So what do you think? What do you think is the problem of having 16 positions with $250 call in each of the position? I'll pose this question. Why is this? If you're 50% in cash, why don't, and you put in no more than $250 into each position, right? Why is that a problem to have 16 positions with $250 in each? Or, you know, $500, 8 positions or something like that. What do you think is the biggest issue in that? Ken. Election, thank you, Ken. Thank you, Kent. $353 support. Right now, Kevin, the support is at 52-week low, which is about 360. 360, 353 when market falls in a free fall. I mean, it's a matter of 10 minutes, right? It could be by the end of the day, market could be from 360 to 353. So, you know, my opinion that somewhere the 52-week will hold, right? But that means it can drop to 350 and then rebound. But to determine support, right? Right now the support is 52-week low, but once that support is breached, you know, the only way to find the next level support is to wait for the signs of stabilization. All right, so what do you think is the problem of having 16 positions at $250 and $10,000 portfolio, or 8 positions of $500? And you're still going to be in cash, right? Anybody? Why don't you want to have 8 positions on a $10,000 portfolio? Why shouldn't you have 8 positions with $500 at risk, or 16 positions at $250? Anybody has any idea? All right. Todd, okay, can't manage effectively, okay. 40% of your portfolio at risk. Okay, good. Okay, we're on the same page. Thank you, Todd. Thank you, Kent. Okay, one is, what's wrong with this position? One is hard to manage. Right, so it's hard to manage. The second one, your portfolio drawdown is greater than 10%, right? That means if you have, let's say, 8 positions at $500, right? And they're all calls, right? Or even if someone calls and someone puts, but if the market goes up, goes down, goes up and down, and these positions deteriorate, the time decay deteriorates, all of a sudden, your risk in here, 8 times 5 is 40% of your portfolio, right? 40% of your portfolio, right? The other thing is you over leveraged, right? Over leveraged. In terms of equity value, right? In terms of equity value. right? Because depends on what these calls are. Even if it's one call, let's say in QQQ, that means you have $30,000 worth of, right? Options are derivative of the stocks, right? They reflect your exposure to underlying, right? You could have maybe one position in Ford and one position in QQQ, but that's 30,000 on a $10,000 portfolio. You're managing 30,000. So when the market drops, 5-10% in a very short period of time, you can be in a situation where you're down 40%. So for that reason, I propose that don't worry that your balance in your broker-dealer account says that you have 90% in cash. That's great, right? When the market drops, the more it drops, the better it is, right? Because you are 90% in cash, right? And at some point, there will be signs of market bottom, right? Usually Fed will tell you, right, when the bottom is, right? Or you see other signs of bottoming process. And then you can start deploying this cash. But deploying this cash when the market is in free fall, probably not a good idea, right? And if you want to be tactical about trading, for that reason, I propose for these specific reasons, I propose not to have more than 4 positions at 2.5% account value. And also is the correlation, right? You have to agree that when the QQQ is down 2% and spiders is down 2%, well, value is down 2.5%, right? High yield is down. If you look at the asset classes, everything, metals and miners down 5%, Germany is down 4%, oil is down 8%, and so on and so forth. Everything falls. So in the bear market, everything's trading in very high correlation. So finding 8 positions that are not correlated to the market is very difficult, or I would say probably impossible, right? Especially for average retail investor, unless you have like a group of value analysts that can find these exotic stocks that are not highly correlated to the market. So for that reason, this is the most important rule, right? 4 positions, 2.5%, because your goal should be, right? You look at the chart, right? Everybody wants to know where the bottom is. And the answer is nobody knows, right? The answer is nobody knows until there's, we have week 1 down, week 2 down, there is no signs of bottoming, right? We could potentially, market can break down like this, right? It is possible, right? If we have dislocation, market will break it down. Or it can do this, right? I can say, okay, I'm 60% confident or 65% confident that we will do this in the next, 4 weeks. But there is also 35% confidence that, market is just going to break through this level and fall, through at least pre-pandemic high. So how do you mitigate that risk? The only way to mitigate risk is, again, you want to make sure that when you were buying, well, today, if you're buying today, but let's assume you were buying at 400, right? Let's assume you were bullish and you thought that the market is going to go to 440, which a lot of people were, right? So the point is that if you drop from 400 to 367, I always said, if the market, for the past, I don't know how many weeks or months, probably since May, I said that if you're entering bullish positions that you're going to hold for a couple weeks or a couple months, this is your stop loss, right? And the point is that if market is here and your portfolio is down 10%, right? You're down 10%, which a lot of people are, then you can have an objective opinion, right? You can say 361 will hold or it will not hold. Maybe I should add, right? Market is oversold. Vlad thinks it's going to bounce. So you can start maybe adding or at least closing some of your short positions, right? That's scenario number 1. Scenario number 2, if you're down 20% here, right? If you had those 8 positions with $250 each and you're down 20%, well, guess what? What usually happens when retail investor is down 20-30% in their portfolio? Let's try to make that prediction. And I actually can see the attendance actually is dropping today. So that means that a lot of people are down more than 20%. That's usually what it means. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit stop loss. Yes. Volatility makes it easy to hit st to 353. Kevin, okay, 353 sounds like a good support. Might there be an end of the day short term? There could be. There's always could be a reversal by the end of the day. So far, it doesn't look like. So far, it looks like we're going to have a capitulation. I mean, 10-year yield was promising. You know, I did have the only good signs of bottoming process. 10-year yield drop, right? It dropped from 380 to 371, right? 10 basis points very quickly, which is great. You know, this is support 368. You know, if it continues on either today or next week to 360, 355, then I would say, okay, we're close to the bottom, right? We're close to the bottom. But as long as we are staying above this 360, 355 level, it could be just a short-term pullback, right? You can see it in 2-year yield, right? It dropped the same as 10-year, and now it's on its way up, which is bearish for the market. Can you say calls or puts? I have more puts these days, right? You can have puts and calls and have more puts. That may make sense. What are your holdings? Again, you know, if you want, my holdings, we'll go over some of them. But again, right now I'm slightly bearish in my portfolio. But if you follow my elite circle and you follow my trades, I'm actually closing a lot of my put positions. So this is an example of iron condor. So I had iron condor on FDX, which I'm closing today. Right, this is the earnings strategy. I had Leonard iron condor, which I'm closing, and I'm trimming my short positions. So I'm closing 25-30 put spread on FCX because it's overdone. Right, it's if you look at FCX, you know, I was aggressively bearish. Right, I was aggressively bearish when the market was, you know, when FCX was at 34 and 32. Now that FCX retesting 52-week lows, and I don't know how far it's going to go, this is the time to start closing the short position, right? So I'm closing SH, closing FCX. I'm going to close XO, trying to close XOP put spread. So these are the positions that I'm closing, right? So I still have some bullish positions, but I have more bearish position. So overall, on a day like today, my portfolio is going up. You know, the market is down 2%. I'm up maybe 70 basis points, and it's going to continue decreasing as we move on. So the question is, again, so usually what happens, so I'm going to go back to my question. So what usually happens when you down, you know, if market reaches 360 and you down 20%, you really don't, you know, you have this fight or flight response, right? Right now, you know, last Saturday maybe, you know, a third less subscribers. So that means that at least 30% of the subscribers are down, you know, more than 20%, right? And when you have 20%, you don't really down more than 20%. You don't really listen, right? You don't know, because you don't know where the market is going to go. You don't really listen or decide. You usually capitulate, right? So you want, the goal of a disciplined trader is to have I didn't still that. Right, to have 4 positions, no more than 2.5%, and avoid fight or flight response, right? So you don't want to be emotional here. So I do understand that stop losses, you know, this high volatility can trigger your stop losses, completely understand. But the problem is that if you don't have stop losses, well, then how do you know how far the market will fall, right? Right now, if you look at the weekly chart, there are really no signs of stabilization, right? We need to have at least one green candlestick before we can say, okay, we'll probably start the bottoming process. Right now, week 1, week 2, you know, next week, if we're below 360 and down, then market, there's no, you don't know where the bottom is. So if you don't have a stop loss somewhere, and you've done more than 20%, then it's just basically emotional trading, right? What's your break point, right? Will 20% portfolio down will be your break point, or will 30%? You know, at some point you will capitulate, right? You will capitulate if you don't have stop losses. Chuck, in $10,000, 2.5 is not much to work with. You can, I mean, no, I mean, $250, you can, you might not be able to trade, you know, spiders, right? But you can do a $5 spread, right? You can buy call on spiders or put, but on a smaller account, you either use dollar cost average and you buy stock, or you use option spreads, right? Even on spiders, you can put a $5 spread or even $10 spread, right? And you know, limit your losses to $250, right? So spreads is my favorite strategy for small account, right? You can buy 25, 30 put spread. You know, I bought it for $2 or $2.40. So 50% stop loss, I'm only risking $120, right? Worst case scenario. So you can do $5 spreads, you can do $10 spreads and limit yourself to loss. Or like NOC, when the stock is $500, then maybe it's not appropriate to buy one call, and $250 is not enough. So you use increment, you buy stock in increments, right? You maybe sell it on the way up, right? And you buy it on the way down. And you can buy one share, right? One share is $500. 2 shares is $1,000. That they sell. Mark, thank you. All right. So the goal is to avoid, again, fight or flight response. So just remember, going back to our Stoic philosophy we covered, you cannot, when the market is down like this and your portfolio is down, we usually, and including myself, we try to analyze, what did I do wrong when the market was at 420? Why did I chase it? Why were my positions were high? Why I didn't predict what Powell said, and all, what went wrong. Again, going back to Stoic philosophy, the idea is process versus outcome. You can't really control the outcome. You cannot control what other people will say or will do. You can only concentrate and you can only control what your thoughts are and what your actions are. And your actions, what you can control, you can control how much cash you have in your portfolio, right? Nobody has to tell you, right? This is your decision. You can control number of positions and position size. And to avoid situation where your portfolio down 10%, if you don't use stop losses, great. You look at the worst case scenario, right? If you don't use stop losses, I mean, where's the bottom? I mean, there are different calls. Some people call 340, some people call 320, some people call 300, 280. I mean, I've seen all calls where the market is going to bottom, right? Because usually people just kind of say, well, historically, right? Let's assume we're in a bear market and we're approaching recession. When do they usually end, right? So right now we're down 25%, right? 20 to 25%. Usually bear market is down at least 30%, right? With recession. So that's February, that's pre-pandemic low. So pre-pandemic low is 30%. Some people say, well, inflation is here to stay. It's persistent. So we might be down 40%, right? So 40%, you're down, 285 level, right? Revisiting the lows of pandemic lows, that would be 53%, right? 53% is 2008 was down 55%, and everybody says, well, this doesn't look like a 2008 scenario, right? But just because it doesn't look like Lehman and financial crisis, I mean, we have inflation. If inflation is stickier and it's going to take a few years to get back to 2%, I mean, hypothetically, we could be down 55%. So nobody knows for sure. So the point is, if you don't use stop losses, you're kind of a long-term investor, you have to consider all different scenarios. At which scenario will you capitulate? In theory, if you're a long-term investor and you don't use stop loss, right, because you're afraid of volatility, you have to kind of predict if you're going to capitulate, right? And since you don't know where the market ends, I mean, realistically, it's okay. It's 300 to 80. I get it. I think that's with all the issues we have right now, inflation, Russia-Ukraine war, Europe is in recession. It looks like US is going to be. I mean, it's reasonable to assume we're going to be down 40%, right? So okay, the low print. Okay, so 280 between now and next, I don't know, 6 months. So if you don't use stop losses at 280, you do not want to be down more than 10%, right? If you're long-term investor, everything is in stock. Okay, you don't want to be down more than 20%, because at some point you're going to have a trigger point, right? And you're going to have that fight or flight response where you say, listen, I'm already down 40%. I can't take that pain anymore, right? These are my life savings, and I don't want to be down 40%, more than 40%. And usually you capitulate, and only to see that the market maybe drops 50%, but then you have a violent rally to the upside. So that's the mindset, right? Especially if we drop below 360, then the next level is, very quickly 340, right? We could, if the market doesn't, if we have this capitulation event, we can quickly happen 340 or 320 or somewhere along those lines. So the goal is to avoid fight or flight, avoid, looking at your account every 5 minutes. The only way you can do this, my experience, maybe there's other ways, but it's only number of position size in cash. Because right now, if I'm 50% in cash, or in my 401k, I'm actually more in cash because I was pretty bearish this year and I remain bearish. I actually want the market to break, and the sooner it breaks through 360, the better it is, right? Because I don't want to sit on cash another 12 months or 6 months. If actually we have dislocations right now in dollar and treasury market, the market quickly drops to 300, well, or 320, okay, then I can start buying, right? Because I can start deploying that 90% cash, because whether it's down 30% or 40% or 50%, I know that historically in a year or two, market will be back to 480, right? In the next 2 to 3 years. So if it's down 40%, okay, or 35%, I think that's a good time to start deploying that cash, right? So the sooner the market collapses or capitulates, I think that's better for the investors, because right now VIX, it's kind of a slow grinding to the downside, right? VIX is steady, no panic. Everybody's kind of just watching the market going lower, 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 and where's the bottom then? All right, any other questions? Yeah, we do have aggressive power trader, and we have different subscriptions on both Tradespoon and Yellowtown. Thank you, John. Kevin, 80% drop by November 9. It's probably impossible, right? Well, there's got to be some kind of nuclear war for November to drop 80%. It's impossible. But okay. Yeah, the Schwab on steroids, this is called aggressive power profit accelerator. That would be the most conservative. So I would start with profit accelerator. Might there be an end of the day short covering rally? There always, TJ, yeah, I mean, there's always could be a reversal, right? 10 o'clock, we're still kind of not there's no, if I have to guess, probably no. If I have to guess, best case scenario, we retest 370, right? And we're going into the weekend, and dollar, then probably not. If I have to guess, probably not. There's no signs. Usually the reversal either pre-market or at least first hour of the market. So if I have to guess, we're gonna continue to test to the downside. I mean, you have to kind of look at 10-year yield and 2-year yield, right? So far, this is no signs of reversal. UUP strength, build, dollar strength, how long can emerging market? I mean, obviously, emerging market is in trouble. Europe is in trouble. I mean, they'll stay solvent. They're not going anywhere. So, but the risk is that, yes, the risk is that there will be dislocations, right? Vertical move to a dollar, right? Just, we're going up, every day by 1%. So if that continues to happen, then yes, then the market will break down. All right. So how do we, so what do we do at Tradespoon? Again, we talked about elite circle. One of the most favorite strategies, again, it's selling out of the money premium, right? I've done this with FedEx, right? This is an example of what everybody is basically doing in this environment. All the traders, option traders. They're selling out of the money premium, right? Here I sold 165 call spread for 35 cents and 142 put for 45 cents. So I collected 80 cents on a $160 stock. It's 0.5%, right? So one of the other important concept is compounding investment, right? Compounding investment. Compounding investment. If I can make 0.5% on FedEx, if I can make 0.5% on Leonard, then even if I make 1% a week, right? In the back of my head, I think, okay, my goal is 1% a week. That means I can make 4%, a year. Oh, sorry, a month, right? That means in 1 year I can make 48%. In a down market, if I'm up 48%, I'm a superstar, right? There's less than 1% of all the traders make 48% a year return. If you knew, okay, maybe 1% is aggressive, maybe just target 0.5%. So you're only going to make 2% a month, and then you're only going to make 24%, a year. But if you're new to trading and you're not aggressive, it adds up, right? If you can make 24% return on your money, you're still, okay, 96% of all the traders in the market. So you're still the top tier of the most disciplined and profitable traders, right? Obviously, everybody wants to make 100% a year, or maybe 1,000% a year, but it's a slow process, right? You can't start and target 100% or 200%. Start with 24%, then go to 48%, and then go to 100. Don't start, there's always the gap between expectations and reality, right? Right. So when you start trading, this gap is pretty large, right? And in psychology, a lot of psychologists refers to this as pain, right? The higher the gap between your expectations and what reality is, right? Reality is, 97% of, traders, just match S&P, right? So, if you're beating S&P consistently year over year, you're already a minority of the traders, right? So this expectation versus reality, that's your pain. In the bear market, that pain could be pretty high, right? As you trade in, that pain, that differential between reality and expectation is gonna, it's gonna narrow, right? And that's how you become disciplined trader and confident trader, because you know what is possible and you know what you're actually achieving, right? So I know we're all starting here, right? But I encourage you to embrace the concept of compounding investment and look for these 0.5%, 1% gains. How do you do that? In a market like this, you sell out of the money premium. You do one contract, you don't do more than one contract. You may be only trading $100 stock, you don't trade 1,000 or $400 stocks. You're selling out of the money premium and you collect 35, 45 cents. I did this on FDX, I did this on Leonard. Right, same thing, sold for 25 cents, call, 25 cents put, 50 cents, $70 stock, okay, a little bit more than 0.5%. Or you trade spreads, right? So FCX is a perfect example, right? I don't know when I bought this, but right. So I bought it for $2.40, closing for $2.90, collecting, 20% return on my investment. But you're long and short the market at the same time. I have a 30 put, which is short, but at the same time, I sold the 25 put, right? Or you do what I did with QQQ. QQQ, I'm actually neutral. I have a put spread, but I also have a call spread, right? I also have 310 call spread that expires in December. And I also have a put spread, right? 280 to 60 put spread. All right. Any other questions? What would be a good stock to sell monthly secured cash puts? Cash secured puts, again, the first rule is 4 positions, right? The second rule is 2.5%, right? Risk. So on a $10,000 portfolio, right, per position, you don't want to be down more than 2.5%. So let's figure out which is a good stock. You probably don't want to sell QQQ on the $10,000 put, right? Because if you get a side, you own $270,000. So usually, no more than 5% of your portfolio. So if you're going to get a sign, you want to probably look for lower stocks on cash. Let's say Ford, right? You think Ford hasn't reached the low, maybe it's the best stock. Okay, so you sell Ford 11 put, right? You collecting 5% dividend yield, right? You sold the 11 put or 12 put, you're collecting 5%. If you're going to get a sign, you're going to get 5%. And then you look at the worst case scenario, right? Worst case scenario, Ford is going to drop to, let's say you sell 11 put, right? Cash secured put. Right, one of your 4 positions. You sold 11 put, and you get a sign, right? Because it dropped to $10. One contract. So you basically own $1,000 on a $10,000 portfolio. 10% of your portfolio is in Ford, right? Let's look at the worst case scenario, right? Realistically, we could reach, realistically, we could probably reach, at least 8, worst case scenario 6. Let's say you reach $6, right? On 100 shares, right? On 100 shares, you're going to be down from 11 to 6 is $500. So then you probably don't want to sell cash secure puts because you might be down, 5%. Or you can sell a cash secure put, but then your stop loss has to be $8, right? At $8, you have to capitulate. You have to capitulate because at $8, you're going to be down $300. So cash secure put, this is how you would look, right? Especially if you don't have stop losses, right? You sell cash secure put, you don't know which stock is going to drop. You have to assume that you're going to get a sign. Then you look at your total value, look at possible scenarios, and your stop loss has to be at this level. So with cash secure put, I encourage you to look at the stocks with the lower strike, stocks that are, in teens, right? $10, $20. Or you look at ETF, right? I said XLK is, on a larger portfolio, maybe XLK, right? $120 stock, you own, if you get a sign, you have $12,000 portfolio. But at least XLK realistically cannot drop more than, let's say 100, right? If you get a sign, let's say you sold 120 put, you got a sign, it could drop to 110, 100. So $20, one contract, $2,000. So if $2,000 is less than 2.5%, then that's okay to do. But if it's not, then XLK is not good, right? You got to find, something that trades in teens, $10, $20. Iron Condor, it wasn't on QQQ. I don't have an Iron Condor. It's more of a straddle. It's the other trade. You can do Iron Condor, or you can do a kind of a straddle, right? So I'm long 300, 310 call spread, but at the same time I'm short to 40 to 20 call spread, right? So it's the short position is 240 to 20, and the long is 300 and 310, right? And I have 2 puts for 1 2-to-1 ratio. All right, it's 10:22. Any other questions? Meanwhile, let's see. TJ is looking for a reversal. Doesn't look like we're getting one. Yeah, so far, you know, I would expect another down leg towards the end of the session. All right, if there are no other questions, thank you very much. You guys have been a great audience. Consider joining us on YouTube, right? On YouTube, you can actually participate live in the live trading room. So you can actually see all of my positions, all of my trades. It's every Wednesday, 8:15 and 1:55 p.m. Just search for the word Tradespoon. Click on subscribe button, click on like button. Be part of the community. You know, you don't want to trade on your own. You want to be able to find a place where you can always ask questions, not get a judgment, and get experience share, right? If you ever been in our live trading room, we have always a lot of subscribers with different experience levels. Some easy questions, you know, are, you know, from the beginners, some are from experts, people who've been trading, managing their own money for many years. So you're gonna get different opinions and different, and I always like constructive dialogue. You know, some of these subscribers are bulls, some of them are bears, and it's a good, healthy discussion. So I encourage you to participate in this discussion. On YouTube, there's actually no financial commitment. So morning bell and closing bell, you can participate. If you're looking for education, you know, we do have one-on-one coaching programs. So consider joining one-on-one coaching program, especially in the bear market. All right, Chuck, TJ, thank you. Aladdin, Alan, Andre, Barbie, Bill, Chuck, Clayton, Don, Kevin, Peter, TJ, Todd, Trader, Virus, and everybody else. Thank you very much and have a great day.